Well, thank you very much, Lawrence. It's nice to be here, and a warm welcome to everybody, and thank you for taking some time away from a beautiful evening in Vancouver, if that's where you are, to take a look at this presentation. Um, as Logan said, my name is David Rowett. I'm a vice president and partner with Strategic Exits. It's a boutique investment bank, and our sole reason for existence is to help high-tech entrepreneurs sell their companies for some more money. Now, in the course of our research, we've come across some interesting developments that I wanted to share with you tonight. And that is that we're seeing more and more virtual companies present in the high-tech space, and we're able to sell them for some more money, and the founders get to keep more of it. And so it's a fascinating research that we're doing, and we're at the very early stages of it. But let me share with you some of the things that we found. First of all, a little background on me. I'm an engineer by training. I've got degrees from Waterloo and UBC. I went to the dark side and got my MBA at the Harvard Business School. But since coming back to Vancouver, I've been working for 30 years in the tech industry at a C-level, either as CEO, CFO, or COO. And I've worked for over 70 tech companies in that period of time. So I've seen a lot of comings and goings in the tech industry. And as noted, I'm a partner right now with Strategic Exits Corp. So in our research, we're seeing the evolution of a new paradigm involving virtual companies. And we'll distinguish virtual companies from conventional bricks and mortar companies that may have a few remote workers, because virtual companies take remote work to the extreme. All the employees are remote. In fact, there's no physical head office for the company. It only exists online. You can't actually find an address for it. And the evolution of virtual companies, we believe, is changing the nature of work in the 21st century. Now, we've attracted some attention with the research that we're doing. Right now, we're collaborating with professors at the Harvard Business School, my alma mater, and at the University of British Columbia, which is also one of my alma maters. And but between the two universities and myself, we're researching and authoring a case study for the business school on a virtual company, the largest one in the world. And it's not a tech company, actually. It's a real estate brokerage company called eXp Realty. But what we're discovering in our research is demonstrating many of the things that we've surmised that are coming to pass with virtual companies as they're becoming a larger force in the tech industry. So let's distinguish it a little bit more carefully. We're all familiar with bricks and mortar companies that have physical addresses where people show up to work. They may have some people working from home, but in the main, people are coming to the office to work. The company has significant investments in leases and fixed assets. Whereas with a virtual company, everybody's working from anywhere they want to. There is no head office, as we've mentioned. There's no lease and minimal fixed assets. When a bricks and mortar company looks to hire, it's typically looking in the local market, whereas a virtual company can hire from anywhere around the world because everybody's online. Commuting is a fact of life, and an unhappy fact of life for many people in a bricks and mortar company, but in a virtual company, there's no commuting at all. And this becomes very important, as we'll see later. So the operating costs for a bricks and mortar company are higher than for a virtual company. And that's because bricks and mortar companies, typically, they have full-time employees, which in North America can cost a lot of money. And there's the attendant costs of compliance. As we've mentioned, bricks and mortar companies have significant investments in leases, fixed assets, and other types of overhead. And they pay a healthy chunk of their earnings in corporate income tax. A virtual company, by contrast, looks a little bit better on all of those characteristics. First of all, they can typically hire contractors instead of employees, many of them gig workers. And if they're offshore, typically they cost a lot less money to hire. And in fact, in some places, the cost of an employee is only 10% of what it would be if you hired that same person in Silicon Valley or in Vancouver. So we mentioned that the fixed assets costs are much higher for a bricks and mortar company and much lower for a virtual company. And if the virtual company organizes its affairs properly, it can minimize the income tax that it pays, and so enjoys a greater return. And so altogether, virtual companies are more profitable than bricks and mortar companies. Virtual companies are capital efficient. Because they have a lower expense burden, they're much easier to bootstrap and to finance. And this has two benefits. One, the founders are spending much less time financing and spending all of their time running the business, which of course is better for the business to have the senior executives spending their time focusing on how to make it grow and be more profitable. But also importantly, if you're raising less money, then there's less dilution for the founders. And this has a profound impact on the founders' payday when they come to sell their company. Virtual corporations are agile. Because they're not constrained by the real estate and physical assets and the financing and all the administrative overhead, they can make decisions and act on them much more quickly. And because they can be managed through constant online communications, the response is much quicker, much easier. And as a result, virtual corporations can scale much more quickly and can disrupt established industries in a matter of a couple of years. And we're starting to see that happen in some of the finance and banking applications. Little startups are making an incredible impact on how that whole industry is structured. I've mentioned that virtual corporations can hire the best worldwide talent because if everybody is online, there are no geographic restrictions. So companies can look for the best employees from anywhere around the world, and often they can do it at a much cheaper cost. But the quid pro quo on that part is, of course, that virtual companies attract the best employees from around the world because many of them would like to work with leading edge companies that are world class and have other best in class employees working for them. Now, employees prefer to work virtually, and it's mostly to do with the soul-sucking commute. Before the pandemic hit, the reports were that people were spending, at least in Silicon Valley, somewhere between 2 and 3 hours commuting every day from their home to the office and back again. And most of those employees would give a huge chunk of their salary if they could recover that commute time and spend it with their family, with their friends, and their other pursuits. And of course, it's much more environmentally sustainable to leave the car in the driveway where it's not emitting a lot of greenhouse gases. There are other advantages to working virtually. Generally, virtual workers have flexible hours. They can work when it's convenient, but they can also enjoy a better work-life balance by putting their families first. If the kids need to go to a dentist appointment or their piano lessons, then the parents can take them there. So they're not tied physically to an office, and they can better allocate their time towards their family and towards their work. So it's much less stressful on them, and it's a tremendous advantage, just particularly for women who have had to juggle families and careers for many, many decades. And as a society, we've done a terrible job of integrating women into the workplace on an equal basis, because typically they unfortunately take more of the childcare burden on themselves, and that's why it's harder for them to devote as much time to their work. But with virtual companies, because they can balance their family and work work requirements a little more equitably, they have a better balance in their life, and I'm hoping that that's going to result in many more women achieving what their total career potential is. Now, having said that, it's also true that during this recent pandemic, many families were in a terrible strait because the kids were home from school. So the home became a place where people not only worked and took care of their families, but it was also a place where everybody worked with the daycares not operating. So everything was happening 24/7, and it was really quite stressful for many families. Once we get back to some kind of new normal where the schools are back working, the daycares are working, then we can see the balance returning to families who can divide their time at home between the office and their family responsibilities. Finally, it's also true that people who work from home have significantly lower work-related expenses. We've mentioned that they can leave the car in the driveway, but they've also typically got a smaller wardrobe, less investment in clothes, and of course, it's a lot cheaper to make lunches in the kitchen than to go out to a restaurant. We've learned some things during the COVID crisis. I started researching virtual companies almost a year ago, and when the pandemic hit in March, it provided a bird's eye view on some of the aspects of virtual companies and how they worked out in real life. And it's been very interesting to note the distinction between large companies and small companies and how they've adapted to working from home. When the pandemic hit, every company in the world, for the most part, had to immediately start to work from home. And many of the large companies really struggled with this. They found it very difficult to adapt to working remotely and online. And that's because companies that had been around for years and for decades had developed office-centered protocols. And overnight, they had to try and forget them and learn how to operate on a virtual basis. And for many of them, it was very, very difficult, particularly the managers. Now, most employees embraced the virtual advantages for the reasons that I mentioned before, but it took the managers much longer to come on board. They had to learn management by objectives, empowering their people, measuring people on their performance rather than how they kept time to a clock. It was very, very difficult for many of them, and large companies were slower to appreciate the value of remote work. On the other hand, when we're dealing with small tech companies like most of us are familiar with, the picture was completely different. There's a company called Remote.co that keeps track of trends within remote work and virtual companies, and they just recently finished a set of interviews with 140 remote companies. It was interesting that most of those companies were virtual, meaning that everybody was working from their home or from the coffee shop down the street, and almost all of those 140 companies were early-stage tech companies. What was particularly interesting is that for most of these companies, working virtually was a passion. It was part of their corporate ID, and it's something they valued very, very strongly. Most of these companies were virtual right from the get-go. It's not that they had to transition; they were virtual right from startup, and they maintained this passion for virtual companies and remote work, and the culture of the company by constant online communication using Zoom and other audiovisual online tools, as we've come to experience almost on a daily basis. So I think it's also fair to say that tech companies and millennial workers naturally gravitate towards remote work. Millennials, were born with cell phones in their hands, and they've been communicating remotely for their entire lives. So it wasn't much of a challenge for them to bring the online culture into the workplace. And so, in conclusion, it's been clear that it's been much easier to start up a virtual company than to transition an office-centered company to virtual operations. Now, I'd like to turn to why it is that virtual company exits make their founders richer. But before I do that, I'm going to need to talk a little bit about tax strategy and cross-border acquisitions, and then I'll present some of the early results from our research for Harvard, and I'll finish off the presentation with a case study on a virtual company that Strategic Exit sold a little while ago. So let's start with the happy news that when there's an exit for a technology company, it's a very happy day. The founders get to sell the company to a buyer who's taking on new technology and quite happy to pay the founders to incorporate their technology into their larger business. But then the government comes along, and the government can sometimes be the biggest winner in an exit transaction, because with various capital gains taxes, dividend taxes, withholding taxes, sometimes they can take up to 20 to 40% of the entire value of the transaction just through these various taxes. Now, the good news is that if you are a virtual company, you can optimize your operations to avoid many of those taxes. Virtual companies can register because they're online. They can register anywhere around the world they want to, and so many have chosen to register in a country with lower transaction taxes, so that at exit time they can avoid many of the transaction taxes that we've talked about, dividends and capital gains chief among them. But the quid pro quo for that is that the exit transaction will likely involve 2 or more countries, and it starts to get pretty complex. International tax strategy is complex, and mostly because there are very few tax and M&A lawyers who understand tax law in any jurisdiction other than their own. And that's fairly easy to understand. If you've ever looked at the tax code, the manual is about this thick. The regulations are many, they're arcane and difficult to understand, so it's hard enough for tax and M&A lawyers to keep track of the changes in the rules in their own jurisdiction, let alone learning the rules in someone else's jurisdiction. So that means that when there's a cross-border transaction, the investment bankers, folks like me, who coordinate the exit, we need to go to work overtime to assemble and coordinate the lawyers for each jurisdiction and and peculiarity of the transaction that's happening. But once we've done our job, then the tax lawyers can go to work, and they can be extremely creative in breaking new ground and saving their clients lots of money during an exit transaction. Now, we're starting to see some regulatory issues rear their head again, particularly in the last couple of months. As you know from the news, the antitrust is starting to turn its attention towards big tech. They've grown big and successful, particularly in the last couple of years. And part of the reason is that they've been able to acquire many, and sometimes hundreds of small tech companies. And so the concern amongst the regulators is that the big tech companies are becoming too big and essentially becoming de facto monopolies within their jurisdictions. And they're doing this by, in part, by acquiring young technology companies. So more of those acquisitions are going to come under scrutiny, I suspect, in the next couple of years. It's also true that political and security concerns are growing. Anytime you sell a tech company outside your country, then you're leaking some of the technology that has been developed in your country to the country that's buying the tech company. And this is starting to become particularly of concern because lots of technology seems to be leaking across borders and ending up in places where governments would wish they wouldn't. So with those concerns, antitrust and security over high tech, we suspect that technology M&A is going to get harder, and especially for cross-border transactions. But again, the good news for virtual companies is that they can avoid many of these reviews and restrictions, again, by domiciling in jurisdictions with fewer regulations. In essence, they're flying below the radar of the antitrust and the security reviews that companies that are domiciled in the United States and North America and in Europe are subject to. Now I'd like to turn to a little bit of the arithmetic around the acquisition of a tech company. So let's start with how a buyer, the company that's buying the high-tech company, how they look at the transaction in terms of valuation. And many of you will have seen this simple equation, of course, that the acquisition price is equal to the normalized EBITDA, earnings before interest, depreciation, taxes, and amortization, times a multiple. Now, the normalization process is adjusting the EBITDA as if the buyer were already running the business, eliminating some of the one-time things that happen so that they can look at the company and its profitability in its steady state mode. The multiple is a very interesting concept because it's the bigger the multiple, of course, the more the buyer is paying for the company. But what determines the size of that multiple? Well, primarily it's based on growth. The faster you're growing as a company, of course, the more your earnings are worth, and a buyer will pay more for them. But there's a lot of other subtle factors as well. For one thing, there's the current market sentiment for mergers and acquisitions. Now, the last decade has been probably the best decade ever for mergers and acquisitions. There's been lots of money around. The economy has been buoyant, and so there's been lots of mergers and acquisitions activity. But you remember a few months ago when the pandemic hit and the stock market dropped 30 percentage points in the matter of a few days. At that point in time, if you were trying to do a mergers and acquisition, very likely it would have been stalled, pulled, or forgotten altogether. The market sentiment has a huge impact on multiples, or even whether an exit transaction can complete. We've talked a little bit about the distinctions between virtual and bricks and mortar companies, and this plays into the multiple as well. To the extent that your company has a predictable revenue stream, then that's something that the buyer can rely on, and they'll pay more for it because it's predictable. If the team is agile, able to execute quickly, and if you've got a strong development team, these are things that add to the value of the company, and buyers will pay more for it. The multiple will be higher. Capital efficiency we've talked about. Resilience is also important. One of the best advantages of a virtual company was demonstrated during the pandemic. Because everybody was working from home, there was no office to go to pick up the virus, and so virtual companies just kept on working as if nothing had happened. The last point is that the strategic fit with the buyer is particularly important because the more your company fits into the technology and the markets of the company that's buying you, then the more your earnings are worth, the higher the multiple, the more they will pay. Now let's look at it from the founder's point of view. How is it that founders look at the value of the company that they are selling? Well, first of all, we start with the buyer's valuation. The founder's retention, the amount of money that they retain in an exit transaction. We start with the EBITDA times the multiple, just as we did with the buyer. But from there, it starts to get interesting for the founders as they're selling their company. First of all, if they finance their company with venture capital, then very likely with each round of venture capital, there's been a layer of liquidation preferences added to the pile of preferences that have been growing over time. A liquidation preference is the amount of money that a venture capital investor will take off the top of an exit before any money is shared with the founders. So that being the case, then the founder's retention, you start with the EBITDA times the multiple, but you must subtract the accumulated liquidation preferences because you're not entitled to them. And it goes from there. The next factor is in the retention calculation is to look at the percentage of the equities held by the founders at exit. If the founders have financed their company with venture capital or with angels or friends and family, then they have a share of the equity as the founders do, and so the founders get to retain only their portion of the exit sales price. So you have to multiply by F%, where F represents the percentage of the equity that the founders still hold. Now you have to pay your taxes, as we talked about. If T% represents the tax rate, then 1 minus T% represents the portion that the founders will keep. So we add 1 minus T% to the calculation, and the formula is getting a little bit bigger and a little bit more interesting. Now, finally, you have to pay your exit costs. To sell your company, you need to engage financial advisors like us, but also tax lawyers and accountants like we've talked about, and they cost money. And typically, they're charging premium rates at exit time, so the amount of exit costs that you pay can be quite significant. So we subtract the exit costs from the calculation, and then we're left with the founder's retention formula as being the EBITDA times the multiple, as we saw at the very beginning, less the liquidation preferences, times the founder's holding percentage, times the amount that you retain after you pay your taxes, and subtracting off your exit costs. Now, that's a complicated formula, but it goes to demonstrate how valuable virtual companies are, because in virtually with every term in this equation, virtual companies outperform bricks and mortar companies. The EBITDA is higher, the multiple is higher. Oops, every other term is higher as well. But let's look at each one in turn to see why that is the case. So if we look at the EBITDA, and we've talked about this earlier, EBITDA is higher for a virtual company because it has lower global compensation costs. It has no facility costs in terms of bricks and mortar, as we talked about, lower administration costs, greater operational efficiency. All told, the EBITDA for a virtual company is much higher than for a bricks and mortar company. Let's say it's for the sake of this calculation, let's assume it's about 50%. The EBITDA multiple is also higher for virtual companies, and we've talked about the reasons why. Typically, virtual companies are growing faster. They're retaining top global talent. They can execute better because the teams are stronger and they're able to work virtually. The founders aren't spending their time funding. The exits are easy. The tech company is easier to acquire, integrate, and relocate. And for all of these reasons, the multiple tends to be higher. And let's assume it's, say, somewhere around 40%. Founders keep a bigger percent of the equity. And we've talked about this. That's where bricks and mortar companies are often raising multiple rounds of financing. So their founders are getting diluted. The liquidation preferences are adding up. Virtual companies can be bootstrapped and oftentimes can finance themselves without any need for venture capital at all. So less need for financing, particularly venture capital, less dilution, and no liquidation preferences. And for all of those reasons, the founders can retain a significantly larger proportion of the equity, say in typically 50% versus 20% for a bricks and mortar company. Now, we've mentioned that that virtual companies can incorporate in a tax-friendly zone where they often don't have to pay any transaction taxes at all. And this, of course, is a tremendous advantage over a bricks and mortar company who are paying the transaction taxes we talked about because they're domiciled in a jurisdiction which forces you to pay them. So if we put some numbers to this one, we can start to see how the advantages of virtual companies come into play in an exit. Say we look at a bricks and mortar company which has an EBITDA of 15 million and an EBITDA multiple of 5. These are typical numbers. So their acquisition price is 15 times 5, or about 75 million. For a virtual company, we've noted that the EBITDA can be 50% higher and the multiple can be 40% higher. So when you plug this into the equation, their acquisition price is 22.5 times 7, or about $150 million. Which means that the buyer, right out of the gate, is paying almost double for the virtual company because of all the advantages that it has. But the calculation gets even more interesting from the founder's perspective. So the bricks and mortar company might have founders' ownership of 20%. They've raised venture capital, so they may have a liquidation preference of $3 million. The transaction taxes might amount to 25% of the total value of the deal. And they may have had to pay their financial advisors and lawyers up to $1 million to conduct the transaction. So when you plug all of that into the founders' retention formula, it looks like the founders will retain $8 million by the time the smoke is cleared. But look at what happens in a virtual company. With the founders' percentage being about 50%, and with no liquidation preferences and no taxes because they've domiciled in a low tax jurisdiction, their exit costs, because the transactions are easier to transact, might be only $500,000. Plug that into the formula and you see that the founders will walk away with $78 million. So that's a tremendous difference. It's about 10 times more for money in the founders' pockets by virtue of being a virtual company right from the outset. Now, we do have to say, of course, that these numbers are quite aggressive because not every virtual company has all the advantages listed, and many of those advantages are overlapping. So we probably double counted and overcounted in some places here, but we're quite comfortable in believing that the exit price for a virtual company can be 50 to 150% higher than for a virtual company, and the founders can earn between 100 and 300% more. That is quite significant. And let me show you how this applies to the work that we're doing for Harvard and for UBC. We looked at the company eXp Realty, which, as I mentioned, was a virtual company, and we compared it to Redfin, a company probably most of you have not heard of. It's a real estate company based solely in the United States. It's a bricks and mortar company, but highly reliant on technology in the way that eXp is. So eXp was founded in 2010, just 10 years ago. Redfin's had 16 years to build their company. But looking at the last year's revenue, eXp raised or generated 980 compared to Redfin 780. So within a shorter period of time, they become much bigger. And their current growth rate, as you can see, eXp is doubling at this point in time, and Redfin is still growing quite fast, but only at a 60% rate. But look at the profitability. eXp lost on an accounting basis about $10 million last year. Redfin lost over $80 million, and in fact has never turned a profit in any single quarter since its founding in 2004. Now, interestingly, because eXp has a founder's stock option program, they have to take on a huge stock-based compensation charge into their income statement, but it's a non-cash charge. And so when you look at just the cash flow, if you look at the EBITDA, eXp generated $13 million in EBITDA last year, whereas Redfin still lost 62.5. So you can see that the virtual company is growing much faster and it's much more profitable. But curiously, when you look at the valuation, it's higher for Redfin. And the reason for that we've researched is that because the public company float for eXp is so much smaller, because the more of the shares are held by the founders, that it doesn't attract as much institutional investment, and therefore it doesn't have as high a valuation. But nonetheless, you can see the other advantages of being virtual. Now, look at this. In terms of the financing, EXP has raised only one small round of less than $1 million, but in its 16 years, Redfin has raised over $700 million in various rounds of equity and debt financing. And so when you clear the smoke away, the founders are still holds 60% of the stock of EXP, whereas the founders of Redfin have disappeared from the equation completely. So it was interesting that some of the factors that we saw that we believed made virtual companies a better bet, we actually saw come to pass when we did our research with EXP and Redfin. And so if you look at this research, the implication for the people, they're watching this presentation, early stage tech entrepreneurs, would you rather start a bricks and mortar company knowing what you know now, or would you stick with or would you move to a virtual company? I think the answer is that we're going to see a lot more virtual companies formed in the next few years because the advantages are not only theoretical, they're real. I'd like to finish off now by talking about a virtual company that Strategic Exit sold a couple of years ago, because it also demonstrates some of the things that we have uncovered in our research. The company was a data analytics company, and unfortunately, I can't tell you much more than that because we're under strict non-disclosure agreements with the company and the company that bought them. But we can tell you that the company was founded by a millennial digital nomad. This was an interesting fellow. He was under 30 years of age, about the same age as many of the people watching this presentation. But he was a digital nomad. He and his wife would travel from city to city, changing places every week or 2 weeks. They really had no permanent address. And he called himself Airbnb's best customer, and I'm sure he was, because he was paying somebody in the Airbnb network something every night that he was basically alive for the past 5 years. A very interesting lifestyle. Not sure I'd want it, but it really worked for him. He had no formal training in software, but nonetheless, he was able to start the company because he saw an advantage in a certain niche in the data analytics market that nobody else was exploiting. He bootstrapped the company. He had no external financing at all because it was profitable almost from day one. And he completed the software development and launched the company inside of a year. And within 3 years, the company had grown to 40 employees. And his was a case study on how to build a successful team. He first chose for his management team other experienced digital nomads, and their value is that they could work without supervision. They knew what they had to do. And so working in a virtual environment without face-to-face contact, this was something that they were used to, and they were able to manage their employees in the same manner. So they brought to bear some of the things we mentioned earlier about virtual companies being easier to manage because of constant online communications. That's how their company operated. They made sure that they hired only the best developers. You had about a week to demonstrate that you could crack great code, and if not, you were probably gone. So they made sure that they had the best employees at all times. And part of the requirement was that all of them had to be committed to the virtual work culture because this was going to be their life while they were working at this company. They hired very smart, self-starting workers who were responsible and accountable and required very little oversight. So it was an ideal setup to grow a company quickly in a virtual manner. After 2 years, the founder determined that it was time to sell, take some money off the table. The company was quickly growing and highly profitable, so this was exactly the best time to sell a company in our experience. And they looked for an investment banker to help them sell. And they chose strategic exits because all of us have had decades of operational experience in the tech industry, and we were also experienced with helping virtual companies exit. So we went to work and we scoured the world looking for the best acquirer for this company, and we found several who were quite interested. The best one, though, was drawn to the company for a number of subtle reasons. First of all, they knew the data analytics space that this company operated in, so they knew that they could assist the company to grow bigger after the acquisition was complete. They liked the fact that the founder had bootstrapped the company right from startup, and so it was very resourceful. They liked the strength of the team and the fact that the company had already, within the space of about 2 to 3 years, had grown very, very quickly and made an immediate impact in a large market. So they perceived the value, and to basically make sure that they bought the company, they made a very attractive preemptive offer, which some days I still can't believe how good it was. And more importantly, well, not more importantly, but also importantly, they signed a letter of intent with a commitment to close in 60 days. And those of you who have been through an acquisition process know that it can drag on for weeks and weeks and months. So a commitment to close in 60 days was quite significant, and was one of the major factors in helping the founders decide to go with this offer. Now, the diligence, which again, if you've been through this process, you know can be extremely time-consuming and frankly deadly. Going through mounds of documentation, making sure that every bit of information is disclosed to the buyer. But when you're a virtual company, all of the records are electronic. There aren't as many of them. And so we were able to assemble a data room and review all of the diligence documents within just a couple of days, something that is quite remarkable. I had actually never seen anything happen as quickly as that one did. Now it came time for the site visit, and as you know, it's a critical moment in the M&A process, as every conversation, every meeting must be tightly structured and executed to make sure that the best face of the company is presented to the buyers at all times. But how do you do that when there's no head office to visit? Well, we did the next best thing. We pulled out a map and we looked at where the greatest concentration of employees were. And we flew our management team, and the buyer flew their diligence team to that city. We holed up in a hotel for a couple of days, interviewing people and going through all of the diligence questions. And we got it all done in a couple of days. But one of the subtle advantages of that was that the teams got to know each other because they were basically living side by side. This, of course, was in pre-COVID days. They were living and working side by side for a couple of days and got to share a lot of personal insights over dinners and lunch. And that's where the teams learned that they were compatible and would be able to work together. And that was an important part of sealing the deal and closing the acquisition. Now, Strategic Exits was pretty busy in this transaction as well. We assembled a very strong exit team. We picked M&A counsel for their cross-border experience so that they understood a little bit about how M&A worked on the other side of the border. We hired a very competent international tax strategist, and we had to hire international tax lawyers in 3 different jurisdictions because this acquisition actually touched 3 different companies. At one point in time, we had 24 lawyers on a conference call all at the same time to make sure that all of the experience was in the room when it was needed. The transaction was very complex, and it broke a lot of new ground, but in the end, it was very successful. The company was able to significantly reduce their tax burden and put more money in the pockets of the founders. It took hundreds of documents to close this transaction, and I'll frankly tell you that I didn't think they were going to make it, because within a week of close, they still had dozens of documents that hadn't even been written yet, let alone reviewed and agreed to. But all of the teams put their their noses to the grindstone and completed all of the documentation. And when this smoke cleared on this transaction, they had done it in 40 days, not 60. So it was a tremendous accomplishment, and it's a team that I'd be happy to work with anytime in the future. So what were the components of this successful sale? Well, we had a bootstrapped company with no investment. They had developed and launched a global data analytics application within a year. They showed rapid growth in revenues and profits, and they were successfully sold in only their 3rd year. And the transaction value was 125 million Canadian dollars, which is quite extraordinary for a company of 40 people only in its 3rd year of existence. But it shows, again, the value of a virtual company and how it can be worth a lot more and put a lot more money in the pockets of the founders. So we look at the key factors here in this case study. It was a virtual company, and we talked about why its exit price is higher. The company and all of its advisors worked very hard. They hired the elite employees who, for their work ethic and their adherence to the virtual work style. And the exit, we were fortunate to bring together a very strong exit team, including M&A advisors, tax strategists, and lawyers. And so the exit transaction went particularly smoothly as well. And so at the end, I'd like to summarize by saying that virtual companies sell for more money, as I talked about, and the founders retain more of the proceeds. And with that, I'll finish and turn it back over to Logan for questions and answers. Thanks very much for attending.
All right. Thanks for that, David. That was very interesting and definitely a lot of things I've never thought about. So I really appreciate everything you shared. I haven't seen any questions come up in the chat, but if anyone watching does have questions, you're welcome to type them into the chat box. Just a reminder, just to make sure you're putting them in the session chat box. But I have a question, maybe, David, that might be
Sure.
interesting. So you mentioned obviously that there's a big difference in there's a lot of different factors in terms of brick and mortar companies and virtual companies. So do you think we're going to see more brick and mortar companies convert to virtual, or do you think virtual companies are just going to come up and maybe take the space, I guess, in a way of what will, yeah.
Yeah, that's a good question. My opinion is that we'll see more of the latter. I think that we'll see more virtual companies founded because it's cheaper. The technology is there to make it happen fairly quickly. I mean, as we talked about with this particular company, they were able to start essentially in a garage or in a basement, and just working online, bringing the people together from all around the world that they needed to further their application. It was not very expensive. It was very time efficient. And once the success of a few of these virtual companies is known in the community, I think we're going to see more virtual companies founded. Definitely. In terms of bricks and mortar companies converting to virtual, well, we're starting to see some evidence of that. Through the COVID pandemic. I think everybody knows that a couple of days after the pandemic hit, the large tech companies in Silicon Valley sent everybody home. Twitter, Salesforce. And what they found, as as I related in the presentation, is the employees really liked working from home because they didn't have to hop in the car and drive for 3 hours every day, and they could attend to their family and their other interests. And so what's beginning to happen is that many of these companies are accommodating to the fact that their employees are not coming back to the office. They're going to stay at home. And for many of these companies, that's actually an advantage too, because if you're paying top dollar rent in downtown San Francisco, that is incredibly expensive. So if half your employees leave and go home and work from their own offices, that's a lot of money you can save by not having to rent that space anymore. So I think companies are going to become more and more virtual. The challenge, I think, we'll start to see, Logan, in the next year or so, because what some of the research has shown is that it's very difficult to be a hybrid company. Either you're bricks and mortar or you're virtual, but it's very hard to be both. And that's because the employees that are still working in the office are closer to the center of action physically and emotionally. And so you end up creating, two tiers of employees, those that are close to the action and in the office, and those that are working remotely and away from the office. And even with all of the communication tools that are available today, you still, are a little bit more distant from the company than if you're working there. And many companies that have tried the hybrid model quickly abandoned it because it just didn't work in terms of the company culture. So big companies take longer to figure things out. So I think we should reconvene a year from now and find out how many of them have decided to go completely remote versus how many have decided to draw more of the employees back into the company.
Yeah, thanks. It does look now there are two questions. So the first question I see is, do you have any tips on how to connect better as a remote team?
Yeah, how do you mean as remote workers connecting with other remote workers? Well, I wish we had the case study that we're doing for Harvard fully written, and I would be able to share it with you. Because what we've discovered is that Zoom, which most companies are using, it's the one that became the big gorilla in online audiovisual communications. Everybody's using it, but it's not the best system. There's another system called Verbella, which was developed in San Diego, which has more of a sense of place. Rather than having just people staring at screens and listening on headphones, within a Verbella workspace, you actually have it's a virtual reality a space where people can have avatars working sort of working inside a virtual workspace, and they can walk from place to place, and people are gathering virtually, and you can walk up to them and speak to them as you walk away. The audio is spatial, so that the voices recede as they get farther into the background. So you have the feeling of actually being there and being present. And for many people that are using this system, they're finding it much better than Zoom because they feel like they're better and more part of the action. And they're able to walk over to people that they want to talk to, or they can pop into their offices because there's facilities to do that in this application. So I think that you're going to see the capabilities of the audiovisual systems improve, so that the sense of disconnectedness, which many remote workers feel, even with all of the online communications that's happening, that's going to start to diminish as these tools get better in connecting people in real time under a virtual reality system. I hope I've answered your question.
I think so. The person who asked it seems very happy with the response. So there's another question here. Can you speak about the downsides to be aware of and best practices / diligence for founders when going virtual from the get-go as a startup to ensure smoother exits down the road?
If I understand the question, I think it is how do you run the business from the day of founding so that it's more easy to exit when that time comes? I think that's the question. But let me answer that question, because I think it's a very good one, and it's something that we've been advocating in our work at Strategic Exits. That when you start a company, you should have the exit in mind right from the get-go. You should know how you're planning to exit, because some of the decisions that you make early on may hamper your ability to exit smoothly and with the most amount of money in your pocket. And the case right off the bat is with financing. And I've mentioned that if you're financed by a venture capital firm, then there's two things that typically happen. One is that you're diluting the company, but you're also adding those liquidation preferences, which the venture capitalists take off the top before they share any of the proceeds with the founders. But the venture capital companies also have a great deal of input into how and when you will sell your company, because they have objectives they have to meet within their venture capital fund that invested in you. And so if their requirements aren't met, even if the exit is a good one on paper for the founders and the other shareholders, the venture capital company will vote against it. And which can be incredibly frustrating and disappointing to all of the other shareholders. So, I mean, there's a case of establishing your company and operating it with the end in mind. If you can avoid venture capital financing, you're going to have more options and probably more money in your pocket at the end of the day when it comes to exit. So that's one. Secondly, I mentioned how the diligence process is much easier with a virtual company because the records are electronic. So if you start from day one maintaining a data room, and every time there's an important document created, a virtual copy of it goes into the data room, then when it comes time to exit the company, the diligence process is so much easier because basically it's already done. All of the documents are there, ready to be reviewed. It takes a lot less time, as we noted with that case study that I told you about. And contrast this with companies that have been around for 4 or 5 years with paper documents, or not particularly well organized on SharePoint, or it can take a huge amount of time to uncover and organize all the documents needed in diligence. So if you do it if you do it well right from the very beginning, then you're going to save a lot of time and frustration on the end. And that's why the exit costs for a virtual company are typically lower than they are for a bricks and mortar company. More questions, Logan?
Yeah, this one is a little bit long. There's a bit of description, so I'll read it slowly.
Okay.
There is some level of jurisdictional arbitrage that occurs with which jurisdictions companies choose to incorporate within. Recently, the Common Reporting Standard, CRS, has helped escalate intergovernmental communication to help limit tax evasion. Can you comment on best practices to stay on the right side of tax minimization and not tax evasion as it concerns jurisdictions, and the complexities of directors with various nationalities looking to found virtual companies?
Okay, so let's start by being very clear about definitions here. Tax evasion means not paying the taxes that are due and payable, and that's a crime everywhere in the world, and there is nobody that advocates doing that. But that's different than tax avoidance. Tax avoidance means structuring your affairs so that you pay the minimum amount of tax, and that's fair game. I mean, that every company does it. In fact, every individual does it. If they're thinking about it. And the issue of jurisdiction is the important one here. So we picked up on that. Is that different jurisdictions have different tax regimes, and in many jurisdictions around the world, they don't levy a capital gains tax. Or tax your dividend income when it's repatriated. So those countries are the best places to form a new company, because when it comes time to exit, then there's no taxes levied on the proceeds, and therefore more of the money stays in the founder's pocket, and that's all perfectly legal. Many companies have found that by organizing themselves to domicile in a tax-friendly jurisdiction, that they can save many dollars at exit time. So, again, to be sure, there's tax minimization by jurisdiction and restructuring. There's tax evasion, which is illegal, and we would never advocate that, nor would anybody else who's on the right side of the law. Hopefully, that's the answer to your question.
Yeah, I think so. I don't know if you answered the second part of the question. Maybe you did, though. The complexities of directors with various nationalities looking to found virtual companies.
I guess I'm not sure I understand exactly what the question is, but let me assume that the question is does it make it easier to operate a company in multiple jurisdictions if you have a more diverse board of directors of different nationalities? And I think the answer obviously is yes. If you are a company that is operating in many jurisdictions around the world, there's going to be many business management practices and cultures that you probably won't understand because you haven't seen them before. So to the extent that you can bring that expertise onto your board to help guide the decisions that you make as an executive, the better it is. There's no question about that. If the question, on the other hand, it was, does it help in terms of the exit to have directors with directors from different jurisdictions? I would have to say probably not. You're relying on your professional advisors, your investment bankers, your tax lawyers, your tax accountants, your M&A advisors. They're the ones that you're relying upon to structure the exit so that it meets all of the requirements, and including the tax requirements, as we just finished talking about. The directors might have some interesting questions to ask about the structure, but typically they're not the ones that you're going to rely on to structure the exit. That's what you have your advisors for. Do we have anything? We got a few minutes left, Logan. Any more questions?
No, I think that's pretty much it. Let me just take a look through the chat. No, I think that's all the questions that are relevant to your presentation. Yeah.
Okay, then. So I guess we're done, and I'm sure that if there are people out there who didn't get a question answered, that you can forward it to the Vancouver Startup Week people, and they'll send it over to me. And if you give me your contact information, I'd be happy to answer your question after we close the presentation today.